Hi, my name is Roy Abramowitz, and I'm here on behalf of MoreThanGrades.com, which is an educational website to educate the parents about the pitfalls and the highlights of sending your child on to a higher education. I am a certified public accountant since 1974. I have an accounting firm, Roy Abramowitz & Company, and our expertise is taxation and financial planning. What I want to cover today is the vehicles that are available if your child is already in high school and you haven't saved for a college education. Well, basically, if there's not that much time to accumulate funds in a 529 plan or other type of college plan, what I would recommend doing, one, there's certain vehicles like treasury bills, which are safe, which you get are not subject to state and local taxation. You could put them in Series EE bonds where you only have to put up half the money, and you don't pay tax until you take the money out tax-free. And if you buy the bond and put it into your child's name, it may be tax-free if you utilize it for education. You could also use zero coupon bonds, where you buy it at a discount. Once again, the interest isn't taxable until you take the money out, but it may be subject to the alternative minimum tax. Again, if you're an older parent, one vehicle that I think is very viable, if you're self-employed and you have a Kia or a SEP IRA, you could put in money if you're over 55 years old or even over 59 and a half, where you start taking out and get a tax deduction for the amount of money that you put in. And then as you take the money out, you're probably going to be in a lower income tax bracket, and therefore you'll be taxed at a lower rate. The other thing is, if you're employed and there's a 401k, if you're over 55, you could play catch-up. And you could put before tax dollars a bigger amount into your 401k and utilize that money and draw it out at a later date for your child's education, hopefully at a lower tax rate.